Hi, I'm Don Davis. I'm a securities lawyer, a very old securities lawyer, because I've been doing securities law for a very long time, which means I have a lot of experience and hopefully some wisdom, and I'd like to share a little wisdom with you in this tape. And this is one of a series of tapes, so you might want to look at our other tapes as well on our website, Don Davis, securities lawyer. And today we're going to talk about an investment in your company, cash, hard cash, cash you need to produce your business assets, to build equipment, whatever. But one of the first questions the investor asks is, how do I get my money back? Well, what an obvious question. I mean, from your perspective, you're not too concerned with that, right? We just want him to write the check. But from his perspective, that's like the second question he's going to ask after he decides he has an interest in the deal. How do I get my money back? So by answering, how do I get my money back, we get his money to start with. And that's the whole point of the exercise. So that's very important. So we're going to talk about that from the investor's perspective. And because I've been doing this so long, we have a whole toolkit of things that we can work with to answer that question for him in an appropriate manner. The first option we'll talk about is a promissory note, a straight old common vanilla promissory note. And we did a segment on that about promissory notes. But now we're talking from the perspective of the investor. A note might be quite suitable for friends or family, say. They put their money in, they get interest, and then they get their money back, and they get interest on their money. And that all works. That answers that question pretty good, particularly for unsophisticated investors. Of course, if it's a high-risk deal, as most of these deals are when they're in the beginning of their startup, the interest rate may have to be pretty hefty to entice that investor, even if he's a friend or part of the family, to write the check. And we can sweeten that deal. We can sweeten the deal with options, with warrants, with a consulting agreement perhaps, all sorts of things in our toolbox to make it more attractive and to motivate that investor so he'll write the check. A second option is convertible debt. Convertible debt is kind of like a promissory note, but with one big difference. If your company takes off, if it hits the stars, if your stock is worth a ton of money, either because you go public, say, or because you sell it to some other company for cash or for tradable stock, the equity shareholders are the ones that get that upside, and not the holder of a note who just gets his note paid off at his interest. But with convertible debt, that's a different story. Now your investor can not only have his interest along the way, some security is going to get paid, but also if it becomes a big company and there's a big hit for everybody, he just converts into the equity, and now he shares in the upside in the equity. Very attractive option for an investor, kind of next level up in sophistication. The next option we're going to talk about is preferred stock. Preferred stock, of course, is an equity investment. Shows up on the equity side of your balance sheet. This is good because it means you have fewer debts and more equity in your companies. Banks like that. They like to see more equity and less liabilities on your balance sheet. So it might be good for you too. Venture capital folks, sophisticated investors like preferred stock. They like it very well. It's well established in our jurisprudence here and around the world as a class of security, and we can put on it all sorts of rights. Preferred stock, you may have a set dividend. The dividend may be only if there's profits for the year, or it may accrue from year to year and be paid at the end. The preferred stock can have various rights. If the business doesn't do well and a venture capital person is writing the check, he may say, well, if you guys run this business into the ground, I want voting control to change the board and put my people on and solve the problem. All doable with convertible stock, with preferred stock. Lots of options there. So we like preferred stock. And of course, the simplest is straight equity, common stock. We sell you common stock, and the question is, well, how do I get my money back? And the answer, you got to give an answer, or they're not going to write the check. What's the answer? Well, we're going to go public. You'll be able to trade your stock over the exchange. That's a pretty good answer. We're a small company in a dynamite industry. We're going to build it up. Everyone's going to want our technology, and one of the big players is going to buy it, either for cash or for tradable stock. That's also a good answer. It's also a sort of a hope and a prayer that's going to happen for the investor. But many investors, particularly unsophisticated investors, will stop there and accept that bargain, put their money in, because they like you, they like the deal, they have faith, and they're buying into your dream, really. And that's great. We need people like that. But there are other options as well. I mean, common stock can be wedded to a buyback, a put, a call, an option, various contractual arrangements. We can create voting trusts so that people own common stock, but they don't get to vote their shares. They give you a proxy to vote their shares, so you keep control, even though you don't have maybe a majority of your company anymore if you're raising big amounts of money. All sorts of tools in the toolbox we can help you with. So I'm Don Davis. I'm a securities lawyer. I hope this little video is helpful, and I hope you'll listen in again. Thank you.